Hello, my dear students. Let's start our lecture 4. And today's topic is statement of cash flows, or in short, we can say cash flows or cash flow statement. Um, so, for the purpose of this chapter, the main purpose of this chapter is to explain the reasons for preparing a cash flow statement. So, why we need a cash flow statement. And also, as we know, in each and every aspect of accounting is based on conceptual framework, most importantly, accounting standards. So, IAS 7, International Accounting Standard 7, is in relation to cash flow statement. So, how we can prepare cash flow statement based on International Accounting Standard 7. We will learn that. So, as we mentioned before, after finishing this chapter, we will be able to prepare cash flow statement. And in our seminar next week, we will see and we will practice how we can prepare cash flow statement following International Accounting Standard 7. And analysis of the cash flow statement, we'll be able to analyze and we'll understand what are the sources of cash flows and what are the ways organization dis disperse is its cash. So and also uh, three and these activities, these the sources and disbursements are actually classified into three categories. We will see later on. So operating activities, financing activities, and investment activities. And after finishing this chapter, we will be able to understand the strengths and weaknesses of the cash flow statement and the details of the process. So it's very simple, and I would like to say that previously, first two chapters were the basics, accounting standards, and conceptual frameworks, and the third chapter that we covered is the ratios, the interpretation of the financial statements, and so the third chapter is actually kind of a mathematics and kind of interpretation of the statements. And so from the last chapter and this chapter is a kind of emphasis on the calculations, on the practical problems. So this lecture would be kind of a smaller, but it includes some practical problems, some mathematical issues. So um, International Accounting Standards approved two methods of preparing cash flow statement. And the two methods are direct method and indirect method. So both are permitted. And you will see if you evaluate the financial statements or cash flow statement in particular, organizations prepare cash flow statement using both kind of direct and indirect. But you may see um, a big number or a maximum organizations follow actually indirect method. So we will learn actually both how these methods works, but we may be practicing indirect one. So what's the direct method? So the direct method is that reports the cash inflows and outflows directly, right? It's a cash flow statement. It's a very simple, and I think you already know cash account, right? So what is a cash account? Cash account shows uh, cash comes in, right? It starts with a cash balance at the beginning of the period, of the month, of the year, and then you will write what are the sources of cash, how the cash is coming to the organizations, right? And the second step is how you are disbursing or paying your amounts. What are the amounts you paid during the month or during the year? So this is what it is. It's very simple. So it shows a cash flow statement actually shows cash inflows and cash outflows. And the direct method is the simply is that which shows the cash inflows and cash outflows directly, right? And start with the major categories of gross cash receipts and cash payments. So how we receive cash. The major sources are revenues from sales, from operations, right? We receive cash. And what are the major area that we spend is the purchase of raw materials, or payment for salaries, or right, or rent, advertisement, or this kind of major area of expenses. Start with those. And cash flows such as the receipt from customers and payment to suppliers are stated separately within the operating activities. So this is, as I just mentioned in the previous point, cash received from customers is the significant or the main sources of income or cash receipts from for the organization, and the payment to suppliers for the raw materials for the product that you are purchasing is the main area where you spend your money or the significant amount you paid for. So these are the areas which are specifically or separately identified in the statement, because these are the major areas of cash flows. Um, is the simply restating the things. So start with gross cash receipts and payments, provide more information about sources or the uses of cash, where we from where we receive cash and to the areas where we spend money. And it shows the operating cash receipts and payments, right? Operating means the day-to-day activities, the areas where we receive and where we spend money. Possibly more useful, the direct method is more useful in assessing the future cash flow. It directly make it clear that what would be or what may be the situation of the cash position of the organization after certain period of time or at a particular point in time. And it's useful to predict um, in whether the organization would be able to pay its liabilities, or whether the organization will fail at a particular time to pay the liabilities or the payables of the firm or of the company. So it's a direct method, is a kind of directly evident to the people, to the customers, to particularly to the suppliers, um, to the financial institutions from where you borrowed money. And the indirect method is, so make it clear. So direct method directly deals with cash, the cash transactions, but the indirect method actually calculate the cash positions from, uh, see, it starts with profit before tax, right? Start with profit before tax. So, uh, and obviously, profit and cash amounts are not equal. So if we want to calculate cash positions, cash amount from profit, we have to adjust the transactions. We have to adjust the accruals, right? We have to identify what are the transactions that happened actually impacting our profit, impacting our cash positions. So we have to adjust those things. So highlight the differences between the operating profit and net cash flows from operating activities, right? As I mentioned before, so we are dividing the activities of the organization into three different classes: operating activities, investing activities, and financing activities. So what we have to do, we have to, the second point it says, the highlight the differences between operating profits and net cash flows from operating activities. So because of operating activities, what are the impact of those operating activities on the profits, on operating profits, how operating activities influences, increases or decreases the cash position of the organization. And particularly it's important in case of indirect method that it highlights the quality of the earnings, right? how you have earned your profit, right? And as I mentioned before, you have to adjust because the profit is not equal to the cash. So we have to adjust the accruals. We have to adjust non-cash transactions like doubtful account expense or bad debts, uncollectibles from the receivables or debtors, or so depreciation expenses, right? Repair, what's called the depreciation, as we say, the um, apportionment of the depreciation or the uses of the fixed assets. These are non-cash transactions which we are supposed to, because if we show depreciation in the books of account, your profit is decreased, but depreciation is not a cash transaction. That's why we didn't pay actually. So the we showed as expense depreciation and collectible. These are expense, but this transaction didn't actually reduce our cash position. So cash is higher than the profit that we are showing. So if we want to find out cash amount from profit, what we have to do, we have to add depreciation expense. We have to add uncollectible expense to find out the cash positions, right? So this is how we have to adjust the accruals to find out the cash positions from profit. This is the indirect method. So more specifically, how we will do it. Step 1, calculate the differences in the statement of the financial position. Financial position statement, as we know already, financial position statement means balance sheet. Okay, so from the balance sheet, and obviously we also know the balance sheet is provided for at least for 2 years, so 2019 and 2020. So what's the difference between 2020 and 2019, for example, in relation to inventory, in relation to machinery, in relation to, say, furnitures? So what's the difference? We have to find out the difference. Then what we have to do, note whether the differences are supposed to be adjusted with operating activities, investing activities, or financing activities or cash equivalents. Okay, so we should know which activities are included under operating, investing, financing activities. So operating activities, as I want to say, operating activities includes, say, current assets, current liabilities, um, say revenues and expenses, right? Yeah. So these are if you find any differences between the expenses in the income statement, differences between the current assets, current liabilities, so we have to treat all these differences under operating activities. And if you find any differences between the figures, for example, furniture 2020 and 2019, machinery 2020 and 2019, long-term investment, okay, so between 2020 and 2019. So these differences are supposed to be included under investing activities. So the fixed assets, okay? So all the differences under or in relation to fixed asset will come under investing activities. And thirdly, financing activities is relating to the borrowings, loans of the organization, long-term borrowings of the organization, right? If you borrow money for long-term, not short-term liabilities, not current liabilities, it is long-term liabilities, and those transactions, and also the interest of long-term liabilities will be adjusted under financing activities. Not only borrowings, it also include, say, the transactions in relation to capital, right? So, for example, share issue or buyback of the shares of the companies. And the second step, identify any items in the statement. That is income statement. So all income statement items should be um, find out the difference. As I mentioned before, we have to find out the differences between the items in the income statement. So 2020 and 2019, or 2017 and 2018. So and then we have to treat them under operating or investing or financing activities. And most of the items stated in the income statement should come under operating activities, but there may be something in investing and financing activities as well. And thirdly, refer to the PPE. PPE is property, plant, and equipment, scheduled to identify any acquisition and disposal and depreciation changes that affect the cash flows. Obviously, as I mentioned before, the transactions in relation to fixed assets. Right? If you purchase a fixed asset, if you sell a fixed asset, and what are the impact of those transactions on the cash position of the organization will come under investing activities. So you have to identify those, and we have to write those things under investing activities. So it's very simple. The format is we have to start with a balance, and then we have to find out the changes in cash position due to operating activities. That is the differences in current assets, current liabilities, revenues, and expenses. And then we will write the transactions, find out the cash differences in the cash position due to investing activities, that is the fixed assets, and the third thing is we have to find out the differences due to long-term borrowings or capital transactions, and then we'll find out the net increase in cash or cash equivalents. What's the net changes? And then we will adjust that net changes with the beginning cash balance, and then we will find out the ending cash position of the organization. Right. So I'll show an example in the second part of the video. Thank you for watching.